Hello and welcome. We can save ourselves from the tax trap by investing in various tax saving instruments. Normally, people have the tendency to do their tax planning when they're near the end of the year. But we should start our tax planning before the financial year nears its end. Thus, in order to avoid making unnecessary investments due to absence of time for planning, we should plan well ahead and research properly before filing for our returns, thus making our tax plan investments useful for us. It is always good to start investing in the early quarters of the financial year. Learning the science of wealth management or financial planning can make you an expert in striking a balance between tax saving, return, and risk. It will require some dedicated working from your end, but as they say, nothing worth comes without efforts. Now let's delve into various tax saving instruments. Every income taxpayer should have life insurance policy not only for tax exemption but also to secure his or her family. According to the budget, life insurance offers tax benefit of up to 1.5 lakh under Section 80C of the Income Tax Act. It is one of the best tax saving instruments. Also, the maturity proceeds are tax free under Section 10(10)(d). The next is health insurance or Mediclaim, which is one of the tax saving instruments and policy that every family should possess as a security against any illness. Under Mediclaim, tax deductions are availed on the premium paid under Section 80D. The premiums up to Rs 25,000 are subject to tax deductions. If we purchase a health insurance for ourselves as well as our parents, then we are eligible for deductions up to Rs 30,000. For a long-term investment, unit-linked insurance plan is one of the good tax-saving instruments. The premiums are invested in debt and equity. It also offers insurance to our investment. We can expect good returns if we invest in it for 10 to 12 years. In case of ULIP, there is no premium holiday. Our policy can get discontinued if we fail to pay the premium. It is the only tax-saving instrument which allows us to switch from equity to debt. The new pension scheme is one of the schemes which give us benefit up to 50,000 over and above the stipulated 1,50,000. We can invest a minimum amount of 6,000 in installments as well as lump sum. An investor can also choose where to allocate money, whether in equity, gilts or corporate bonds. Equity-linked tax-saving scheme is a short-term investment option with lock-in period of 3 years. The minimum amount which can be invested is Rs 500. As it invests in equity, ELS is a good tax-saving instrument for even long-term. We are not bound to continue after the lock-in period gets over. It is always better to invest our money over a period of time than investing in lump sum. PPF. This is one of the most preferred long-term tax-saving investment options under Section 80C of the Income Tax Act. It has a lock-in period of 15 years and can be extended in blocks of 5 years. The minimum amount that can be invested in PPF is 500 rupees and the maximum amount that can be invested is 1.5 lakhs. It is one of the best tax-saving investment for the people who are not covered under the Employee Provident Fund like the self-employed professionals. It is a fixed deposit service which is offered by the post office. Apart from this, a person can claim a tax benefit of Rs 10,000 against interest received from a bank. For senior citizens, it is Rs 50,000. In case of house rent allowance, an individual can save total tax worth Rs 60,000 or 25% of total income. Section 80E exempts interest on education loan taken for 8 years. Section 80EE exempts first-time home loan takers up to Rs 50,000. The bottom line is that we should plan our savings not only for tax exemptions but also for a better and financially stable future. If we do this, we can retire comfortably and our second innings will be peaceful. I hope this video answered a few questions when it comes to tax planning and investments. Until my next video, it is goodbye.